This is our Forex blog for August 18th, 2011. And like most days, we look at the currency meter to find the strongest ones to buy and the weakest ones to sell. This is the second day since we've released Build Your Own Color Strip. And what this does is allows you to look at an intermediate time frame trend. In the past, we focused on the daily, weekly, monthly trend. If they all line up and the real-time strength is there, you want to buy that one against the weakest one. Sometimes the daily, weekly, monthly trend can be down, but there's incredible intermediate term strength in a currency, and that's what this tool does. In order to focus on this new tool, I remove the daily, weekly, monthly, and it basically allows you to create a weighted strength or weakness tool, this color strip underneath the real-time tool, and it uses some fast and also some intermediate to long-term statistical trend tools to give you an idea of which currencies are strong and which are weak. So starting the day off at midnight, you can see real-time strength in the dollar, and the intermediate strength was strong, and it has been for a couple hours. You want to trade that against one of them that's weaker. Let's scroll back. The euro had a little bit of weakness here at 12 to 12, maybe 30. So the euro dollar could have been one you sold. The Swiss was strong, so we wouldn't want to buy the dollar against that one. Clearly, the New Zealand is quite weak on all time frames at midnight, and so is the CAD. So basically, at CAD, we're looking for, at midnight, we're looking to buy the dollar against the New Zealand and the CAD. So we're looking for some New Zealand dollar sells, weak New Zealand, strong dollar. Here it is right at midnight. You can see the trend is down. It's underneath the hourly. It's also underneath the 15-minute average. You have a nice little pullback right here, and it breaks down, and you can see it fell from 83.53 all the way down to about 18. Nice 30 pip move there. Alright, sorry about that. I forgot to put the charts on. Everyone see them now? Okay, cool. Alright, so using the currency meter, this is one of the ones you're focusing on. Again, the CAD is also weak, so you want to buy the strong dollar versus the weak CAD at 12. And notice again, price is above the hourly, and it was above the 15-minute average. Pulls back, finds support the hourly, and it really starts to go strong. You might go long into this when it breaks out over this trend line. And this one really only goes up about 20 pips, kind of goes around sideways. You have a nice little flag pattern here for a while, and then it breaks out again. But later in the day, you can see some short-term weakness. When you start to see some strength come back in, you might want to go long. You might have a break-even or a small loss here, and eventually, this trend continues. The dollar was exceptionally strong a little bit after 9, and you can see the CAD was probably one of the weakest ones at 9, and that's why the last trade was the one that really went. Sometimes currencies trend all day long, and other times they make little 5 to 15 pip moves up, go sideways or pull back 5 to 10 pips, chop around. Some days are harder than others. Today was a relatively choppy day. But you want to focus on ones where the real-time strength is plus 80, and it matches the intermediate time frame trend. For example, the New Zealand switched from a downtrend to an uptrend, probably due to this strength right here, and at 540 it was strong on both time frames, again at 630. So you'd want to look to buy the New Zealand against whatever one was weakest from 530 to 730. Let's see, what's the weakest one on here? It might be the euro. Now at 5:30, the euro had some real-time strength, but at 6 right here, when it goes weak, and unfortunately the New Zealand at that time had also gone weak, so in real time you wouldn't have picked that one, but I can bet you that the euro New Zealand fell slightly after that when this weakness came back and the strength popped back. So you're basically looking for trades on this on a pullback. Euro New Zealand, it's weak during that time after 6, and you can see that this did pull back up. It had a counter trend move. The only drawback to this trade is it's above the hourly, and the hourly tends to be a pretty high probability place to find support. If it's above there, it tends to be support. If it's underneath there, it tends to be resistance. So you have a nice little short there on that pullback. You can see the real-time strength was lessening, and it actually went weak on 6:30 right here. So this is one of those anticipatory trades. Not the best trade in the world, because you ideally want to be underneath the hourly to sell. One trade I saw that was incredible was in the yen. The yen, for the most part, the intermediate time frame trend was up all day, and at 9 again it became very strong. One of the weakest ones consistently through the day was the CAD and the Australian, and this was weak coming into 9. Exactly at 8:55 it goes incredibly weak, and 8:55.9 the yen is strong again. CAD yen had a beautiful drop right around 9, and you knew about it at 8:55. If you look at this chart, here's 8:55. The market's kind of going sideways. It's underneath the hourly. Notice the difference between this trade and the one that was above the hourly. That was a support area, and it found support. This one's trending down, and you might have shorted this when it kind of broke this little trend line right here, or you might have waited for it to actually break the lows, which was not at 8:55, nor was it at 9. It wasn't even at 9:05. It was on the 9:10 bar, and you can see this fell 10, 20, 30, 40, 50, 60 pips down. Pretty incredible trend, and when you focus on one currency that's pretty much weaker in real time than every other one, and the intermediate time frame trend is also quite weak. As you can see, it's quite dark red even before that intense drop. And the same thing goes with this, quite strong. Now earlier today at 6 or 6:20, you have strength on both time frames here. Unfortunately, the CAD at that point is not the it's not the weakest one. You're not always going to get ones that perfectly line up. The Swiss is relatively weak at that point, so you can look at a Swiss yen sell. Now notice the Swiss got strong 5 to 20 minutes after that, so this may be one of those trades where there's not the biggest drop in the world. Weak Swiss, strong yen. You can see that was underneath the hourly and broke down. And there wasn't really much to that trade. It just kind of double bottomed here, and then it reversed, and later the trend even went up even more violently up when it broke the hourly. So whether you shorted it here, or here, you had either a small win or a break even or a small 5 or 10 pip loss. But you rarely ever get burned big time when you're trading with both of the trend directions. Today was a pretty choppy day. As you can see, there's a lot of green for half an hour to hour, and then red. The FX Trend Pro is a real-time tool, and the one on the bottom is more of a blended multiple time frame tool. It only works live. When you add it to the chart, it starts updating in real time, and it shows you, what the strongest and weakest ones are. In tomorrow's class, I'm going to have the daily, weekly, monthly underneath here. So when the intermediate time frame trend matches the daily and preferably the weekly trend, and the real-time trend matches it as well, you're going to have even higher odds. You can see that the CAD uptrend shifted, from a downtrend all day to up right around 1150 here. What is the weakest one from around 1150? This one, the Australian, is extremely weak, but unfortunately the real time's not there. The euro also is weak, and let's scroll back forward here. So around 11, the euro CAD would have been a good one. Not 11, 1140, 1155. The euro CAD was quite a good one a little while ago. Now notice that price is just at the hourly right here, just like the other example I gave you. When price is above the hourly, it tends to go up. It's a much riskier trade selling right in front of the hourly. So for that reason, you might not have taken this trade. You can also use our new range bars to get a little better feel for this. You might use a 6R. 6R seems to be a pretty good value to use on this. So 1140 coming up here. You knew this was quite weak. Whether you sold it right here with your stop, using a range bar, you can have super tight stops and take trades that you wouldn't normally take. For instance, by using a 6 pip per bar range bar chart, you can add 1 to 3 pips to the other side and you risk a tiny amount. And you can see in this example, this trade, even if you shorted it so late into the game, it still fell another 20 pips and you're risking 10. So the key to trading is having small losses, bigger wins. And another method that you can use on range bar charts, whenever you see a strong trend and you get a 2, 3, 4, or 5 bar pullback, in other words, green, green, the trend's down, green, green. First bar that goes red, you go short with your stop right above here. And, obviously this is pretty late into the game and it's finding the hourly moving average right here. So you want to be quick to move your stop to break even. If you see the real-time strength and weakness of this continuing to support the trade, you might want to leave your stop here so that you have a potential of catching 20 or 30 more pips. If you don't believe the trade's going to work, you might want to exit with a 13, 14 pip win, because you can't always hit home run trades. Big, huge 20 to 50 pip or more wins should be probably 15 to 20 or 30% of all the trades you take. The rest are going to be small wins, small losses, break evens. So there's nothing wrong with exiting half your trade here with 10 or 11 pips and moving your stop down maybe a little bit. So at least you lock in 3 or 4 pips or 5 pips on the other half and let it run. Again, this is above the hourly, so the hourly moving average is acting as support. Let's look at one more example for our blog and then we'll do our regular class. Well, the Australian was also weak throughout the day. At 230, it had, or 240 here, it had incredible weakness. 235. What was the strongest one at 230? Well, both the dollar and the yen were both strong there. So the Australian dollar at 230 would have been a good one to sell. Here's 230. You can see if you sold the low of that bar here at 93, it went down over 20 pips. You got a nice little pullback trade right here. The trend continued. Another pullback trade. The trend continued at 5 o'clock right here. Notice the dollar is quite strong still on both time frames. And at 5 o'clock, the Australian, actually a little bit before that, at 4:45, the Australian started to get weak. So 4:45 is right here on this little tiny green bar. Other Australian pairs started to go down. The dollar was strong, broke this little wedge pattern right here, and you can see it fell 10, 20, 30, 40 pips. When you focus on currencies that both trends are going one way, you typically get these much bigger wins than your losses. You're risking 6 to 12 pips, and you frequently find 20 to 50 pip moves. Let's end class today just by going over the Australian dollar range bar chart at 4:45. This gives you a little bit better view for the market and allows you to spot patterns better, in my opinion. So here is a 4:45. You can see on the range bar chart kind of a double top here and also another mini double top, and you can have a tinier loss by using a range chart because it double topped right here, the market came down. There's no need to have your stop up here because clearly you have a nice little double top here and this low broke this low. You can spot levels. One of the signs of a downtrend is when markets make lower lows and when highs are also lower. This is slightly lower than this high, so very high probability you get in this trade with your 6 pips per bar stop plus a few pips padding once it breaks down, and you can see it kind of goes down here sideways, and here's the low. If it was going to find a double bottom right here and go up, then at least you can move your stop down right here and you've locked in 3 or 4 or 5 pips. And as it continues, you can draw your fib target on the last wave down and get an idea of where to get out of the trade down here. You got into this trade maybe around 80, maybe 81, or even 79, but we'll just use 80 because it's easier. And when it comes down to the fib target here at 45, you're out with a nice 35 pip win, and you have a 6 pip stop plus 1 to 3 pip padding. So you made 3.5 times what you risked. And that's really the key to trading. Even if you're 40 or 50% accurate and your wins are twice as big as your losses, and you saw that the last few examples are the wins were 3 to 4 times bigger than what we were risking. That's the key to trading. There's nothing more to be said. Small losses, bigger wins. Range bar charts allow you to do that because you can set the number of pips on your range bar chart to whatever that currency trades. For example, you want to add our indicator called ATR. And if you want to see the volatility from 3 to 12, the most active times of the day, you can add that to the chart, and you can see about 5 pips per bar is the average. So I use 6. For the Australian dollar, you might want to use a 5 pip per bar chart. There's no reason to risk that one extra pip because this one on average from 3 to noon Eastern time, New York time, trades on average 5 pips per 5-minute bar. This is a 5-minute chart. If you normally trade 15-minute bar charts and you want to create a range bar chart that matches it, guess what? A 9 pip per bar chart would be equivalent to a 15-minute bar. So just to end today's class, if you want to see this as if it was simulating a 15-minute bar, put 9R on here. And here is a 15-minute chart. Now, clearly you can spot, delicious patterns on here. Notice that trend line there that held support. You get, as the trend goes down, multiple bar pullback, 1, 2, 3 bar up, 1 bar red. You go short right here with your stop above the high. That trade worked out. Usually it's 3 bars in a row that you want to take those trades on. This one really didn't close up on there. It went down and it barely is a wick, but you might have taken that trade there with a loss. This next trade, and by using a certain number of pips per bar, when the trades work, you can pretty much count your multiples of what your risk is. If you're risking 9 pips and the bar moves 3 times, then you have a 3 times bigger win than loss, because most bars, high minus low, is in this case 9 pips. You can also, if you shorted that low down here at with your stop above here, and this is using a little bit wider time frame, bigger pips per bar, you can move your stop down above each bar's high, and if the trend's going to continue, most of the time you're going to stay in it. In this case, you got out here with a 20 or 30 pip win. You might have shorted it when it went down again here, and you made another 20 pips on the second entry.